to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. First of all, I hope you and your families are all well, healthy, and safe. We're living in crazy times, but not everything is bad news. I know a lot of you now have gotten your stimulus payments, so I wanted to talk to you about some of the best ways to use that money. Now, obviously, if you need that money for current living expenses, then there's no reason to think about it. You got to do what you got to do, whether it's making your mortgage payment, your rent, etc. However, some of us are lucky enough to have received a stimulus payment and not necessarily need that money to pay our living expenses. So what do we do with it? The first thing I recommend is to look at your current situation in terms of your savings, emergency savings in particular. Typically, as financial planners, we recommend that people have anywhere between 3 to 6 months worth of expenses. Now, I know that that's not necessarily feasible for a lot of people. However, it doesn't mean that you shouldn't have any either. So if you could at least come up with $1,000 that you can have in a savings account just for an emergency, the average American is not even prepared for a $400 emergency. And that is just terrible. I mean, this situation that we're going through right now, with almost 30 million plus people out of work, has really, really amplified how important it is for you to have an emergency savings as much as you can. It doesn't mean that you'll have the 3 or the 6 months that are needed. Hopefully, if you're a couple, for example, you might not both lose your jobs at the same time. You got to aim for something. And this might be a great time for you to take a look right now, take a hard look and say, do I have enough in case of an emergency? Or do I have enough if one of us loses our jobs, even to cover 1 month's worth of expenses? And if not, what's the alternative? So think about that. The second thing I recommend, if you're already well established as far as your savings are concerned, well, consider paying down some debt if you have some. Look at the interest rates, the APRs to your student loans, credit cards, personal loans, and things of that sort. It might be better off using that money, for example, for a 26% credit card than leaving it in the bank that's paying you, if you have it in a high yield savings account, maybe 1.5% today. Now, why did I not say to pay your credit cards off first? It's because the savings for emergencies, in my opinion, takes more importance than a credit card. And here's the reason for that. Imagine you have zero savings and you get a flat tire or your radiator blows out. You need $800 and you don't have the savings. Well, what do? You put it on a credit card. Now that $800 is accumulating at, say, 26% interest rate. Now, had you had the savings, you would have dipped into your savings, pay off the emergency, and then continue to rebuild back your emergency savings and not have to pay that interest, right? So it ends the cycle. So think about it that way. It ends the cycle of having to live on that credit card, using it like an accordion. Don't have your credit card as your emergency savings if you could afford to put some money away. What about, have you considered contributing to a Roth IRA? I'll give you a little bit of an example what a Roth IRA is versus a traditional IRA or your 401k. Typically, when you contribute to a retirement account, say your 401k, for the most part, the IRS does not tax you on the money that you contribute because you're doing it on a pre-tax basis. So, for example, let's say you contributed to a traditional IRA or your 401k at work, and you made $90,000 and you contributed $5,000. Well, you only get taxed on $85,000 that year because that $5,000 that you contributed is a tax deduction dollar for dollar directly from your taxable income. So like when your W-2 gets issued, it will not include that amount that you contributed to that 401k. If you did your own IRA, then you just state that on your tax return and it comes off of your taxable income. The Roth IRA is the complete opposite of that. It's the flip coin where you do not get a tax deduction today. However, the amount that you put in and the earnings over time get to grow tax-free if you hold it for a minimum of 5 years and wait until you're age 59 and a half to touch it. And that can be a great benefit because then you're setting yourself up for having tax-free income during retirement. I know some of you listening might be very young and retirement is the furthest thing from your mind, but trust me, your retired self will thank you when you have a big pot of money that is not taxable by Uncle Sam. So one thing to consider. Also, the tax deadline has been extended to July 15th, and typically the contribution deadlines for IRAs also follow the tax deadline. So you actually have until July 15th, 2020 to still contribute towards your 2019 contribution. So for some of you that aim at maxing out a Roth or have not even thought of it, you still have time to open one and contribute towards your 2019 tax year, which means that you're going to have until April 15th of 2021 to contribute towards 2020. So this is a great opportunity here for those folks that do not need their stimulus payment to pay the living expenses. This might be a great option for you to just start a Roth and do some future planning there. Now, what about catch-up contributions? Those are for people that are ages 50 or older. There's an additional $1,000 that could be contributed. So the limit is $6,000 for individuals under age 50, $7,000 for people 50 and older. And you can contribute to a 401k and also to your Roth IRA if you meet the income limits set by the IRS. What about kickstarting your budget? Usually when I work with clients, I tell people to break down the larger amounts of expenditures during the year to smaller chunks. So let me give you an example. Let's say that you have $3,000 that you like to spend on vacation per year. That's $250 a month. If you get paid twice per month, it's $125 a paycheck. So I usually tell my clients, why don't we then set aside $125 per paycheck so that when the vacation comes, you already have that money set aside. You don't have to use a credit card or figure out how you're going to pay for it. Now, some of you might not have done that before. So your vacation might be coming up soon. Now, granted, these are unusual times. So maybe you took vacation during the summer and that might not be happening this year. But under normal circumstances, maybe you're taking a vacation later at the end of the year. This might be a good time to kickstart your fund where maybe you can use some of your stimulus payment to kick off that quote unquote bucket for your vacation or even holiday spending. How much do you spend during holidays? If you haven't saved for it yet, this might be another good opportunity to take that money, set it aside, either open up a separate savings account or earmark it for those expenses later on in the future. What if you have children? Have you ever heard of a 529 plan? Before, it used to be only for higher education purposes for college. But now the definition of qualified expenses has been expanded where you can use money from your 529 plan towards elementary school, higher education as well, even private or religious schools. You put after-tax money into it, but the money gets to grow tax-free if when you take the money out, it's used for higher education expenses. So some of you that have children there that have not started a 529 plan, you might want to consider that. There's a great website, which I'm going to put in the notes, savingforcollege.com. It lets you know everything you need to know about 529s. There are additional tax benefits. So if you open up one in your state might also deduct the contributions that you contribute to your 529 from your state income tax up to a limit, which is a great benefit. And you can use it towards a certain beneficiary, but they're flexible. So if your child gets a scholarship, you end up not needing the money, you can put it towards a different child. You can make yourself a beneficiary, go back to school, things of that sort. So there's a lot of flexible ways. A great planning opportunity here for those of you that have children. If you receive the additional $500 per kid, maybe just take that part if you need the money for other things and start a 529 today. So savingforcollege.com, great website. I'm going to put it in the show notes. Wanted to also talk to you about health savings accounts. For those of you that have a high deductible health plan through work, a health savings account is a great tool that you can use. The current limits right now set by the government are $3,500 per individual or $7,000 for a family per year, with an additional $1,000 catch-up contribution for ages 55 and older. Now, health savings account are a special breed because you can technically have triple tax advantages on this type of account. This means that you can put money into it pre-tax. The money gets to grow tax-free if when you take the distribution out, it's done for a qualified health expense. So pre-tax money goes in, the interest that it makes, because you can either put it in savings or invest it, is tax deferred. And when you take the money out for higher education, I was talking about 529s, for qualified health purposes, it's tax free. And it rolls over year. So you don't have to use it or lose it like a lot of employer benefits. This stays with you. So you can plan ahead and put money. If you're nearing retirement, for example, you can start putting money into a health savings account and then take it out later for your medical expenses tax-free. So another tool you can use. Now, speaking of insurance, what about life insurance? If you're listening to me right now and you do not have life insurance and somebody else depends on your income currently, you might want to consider taking the money that you got from your stimulus payment and buying yourself a policy. Now, you don't have to go buy a super fancy product, whole life and all this other stuff. Maybe a straight term life insurance policy would work, which is just the cheapest form of insurance that there is. You literally buy insurance for a specific term, which is 10 years, 15 years, 20 years, 30 years, whatever that term is. So if you're 40, you might want to buy a 30-year that would cover you into your 70s. Things of that sort. If you have young children that depend on your income, if you have a spouse, this might be a great time. And the younger you are, the cheaper the premium is going to be. So if you have that stimulus payment sitting around, you already took care of your emergency savings, you don't have much debt or very little, might be a great opportunity for you to purchase a life insurance policy with that money. So think about basically getting a freebie, right? Just getting a stimulus payment and say, you know what, I'm just going to buy this life insurance policy now. Now, some of you that already have all those other things in place, you can also donate to charity. There are some benefits now with the CARES Act. Even if you don't itemize your deductions, you can deduct up to $300 from your income, even if you don't itemize. So this might also be a great opportunity too, if you have particular charity that you like, or you want to donate for first responders to get personal protective equipment, things of that sort, be a great opportunity as well to use some of that money. Now, what about if you're self-employed? I know a lot of my self-employed clients, sometimes they're either not able to, or just honestly, sometimes they forget to send estimated tax payments to the IRS. So you might be a real estate agent, for example, you might be an Uber driver, and you get your 1099 at the end of the year, which had no taxes withheld from your pay the entire time. Well, you're probably going to owe a lot of money at the end of the year. So maybe you can take some of this refund money that you got from the stimulus and send it over as an estimated tax payment towards next year so that you owe less. That could be another way of looking at it. I wanted to touch back on the credit cards because there are certain strategies that you can use. Let's say you have a credit card that you can put a significant dent on it with the stimulus payment. You could speed up the time that it'll take to pay that credit card off. Say you have a 0% APR balance transfer offer from an existing card for 16 months. Well, maybe you can take the stimulus payment, send a chunk of that to the card, and then transfer the balance at 0% and make it so that you have the full balance completed before the new APR kicks in. So that could be another quick budgeting strategy that you could do for debt reduction. So there's a lot of ways that you can use your stimulus payments instead of just letting it sit there in a savings account, probably making hardly any money, unless it's your emergency funds, right? But if you already have your emergency funds, these are some of the strategies. So I wanted to just basically recap. I would recommend look at your emergency savings first. If they're not adequate, put your money in there. If you do have adequate emergency savings, well, let's look at your debt next. List the name of every creditor, the balance, and the APR, and then figure out the best strategy for that. You can use a website called powerpay.org, which I'll also put in the notes. You can log in, it's free, create an account. You can come up with a debt repayment strategy there that will be the most beneficial to you. It prints out a calendar of how much to send to each, how much money you save in interest. You can do a lot of scenarios if you want to pay credit cards by the highest balance first, if you want to pay credit cards by the highest interest rate first, the lower balance, if you want to compare it to consolidating versus paying it on your own, things of that sort. It'll be super helpful to do. Powerpay.org. Make sure you check that out. Consider a Roth IRA. Funding a money now, an account with post-tax money that you can use later in the future with no taxation if you do it right within the guidelines. You can use it to kickstart your budget, holiday spending, and vacations. I know vacation is probably something that is on your mind, but it's probably not going to be feasible. But at some point, things will go back to normal, and this will be a great way to kickstart that project. If you have children, 529 plan. Go to savingforcollege.com. This might be a great way to just kickstart the 529 that you'll be meaning to do. Now you got the money to do it. You don't need to put a whole bunch of money in there. You could kickstart it with very few. Most states that have their plans will let you start it with very little money. I'm talking like $25, $50 if you have it. So this great opportunity. Health savings account. $3,500 limits for individual, $7,000 for a family, plus $1,000 catch-up contribution for ages 55 and older. So if you have out-of-pocket expenses and you have a high deductible health insurance plan, you can put money into a health savings account, get a tax deduction, and then use that money to pay for medical expenses tax-free. Great opportunity there. Life insurance. If you don't have it, maybe you can use some of the stimulus money to purchase yourself some insurance. And it doesn't have to be a fancy product. It can just be a straight term insurance policy that at least covers your family. A very well-placed life insurance can have impact for generations. So think about that. Charity, again, if you are in a great shape and you want to help others, well, maybe you can use some of that and just send it to your favorite organization or help the first responders get personal protective equipment that in so much need right now. And if you're self-employed and you have not sent your estimates, I know that maybe your income is not going to be as much this year, but if you still didn't withhold any taxes from your pay up to now, you might want to take some of that money and send it to Uncle Sam, which is kind of odd because you're taking money from the government to send it right back to the government, but at least it'll be credited towards your taxes for next year. Thank you all for the feedback. Going forward, the show is going to air weekly starting next week. So every Wednesday in the middle of the week, Wednesday mornings, you have one episode from me, brand new. I will promise to stay on schedule. I thank you all for the feedback. Thank you, everybody that gave me the idea to make it weekly. The demand's there for it. So I appreciate you guys listening. If you have any questions, send me an email at luis@onmywaytowealth.com. If you have any comments, questions, suggestions, there's anybody that you'd like me to interview, or if you want to be interviewed yourself, you think you have something that you can provide for my listeners, shoot me an email, luis@buildabetterfinancialfuture.com. Thank you for listening and stay well. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.